Welcome to Breaking News to Trading Moves. We are looking at a specific headline coming out of the Nasdaq today.
Yeah, it's a collision between two massive themes we discuss pretty often. You have the revival of nuclear energy and that absolute hunger for power coming from data centers.
Right. And it's a combination that has traders paying very close attention right now. We have a new player entering the uranium space.
We do. And the way they entered and the timing of it, it tells us quite a bit about market appetite.
So to connect the dots here, the headline event is the debut of Eagle Nuclear Energy. They just completed a merger with a blank check firm.
Spring Valley Acquisition Corp. 2 specifically.
Right. So they are now officially trading as a public company.
And, the market didn't wait around to form an opinion on this one. The stock moved up approximately 14.6% intraday right after the debut.
Which is a really healthy pop. But we aren't here to just watch the ticker tape. We need to look at what this actually signals for you, the listener, as a trader.
Exactly. Because we have a new listing, a specific asset, and a timeline that stretches way out into the 2030s.
Yeah. Our job is to look at the mechanics of this listing, figure out what they actually own, and then follow the money. We need to see who wins and who loses when a story like this hits the wire.
From the miners to the utilities, all the way down to the solar and fossil fuel sectors, we're going to break it all down.
Let's start with the company itself, Eagle Nuclear Energy. If you are pulling it up on your terminal right now, they are trading under the symbol NUCL.
Which is about as on the nose as you can get for a ticker symbol.
It certainly is. They grabbed that vanity plate early, so they merged with Spring Valley Acquisition Corp. 2. This is a classic SPAC deal.
Right. But whenever a resource company lists, the flashy ticker doesn't really matter if the geology isn't there.
Exactly. What do they actually have in the ground?
Well, their flagship asset is the Aurora project. It sits right along the Oregon-Nevada border.
Oregon and Nevada. Okay.
Oh, yeah. And the filing documents describe it as one of the largest undeveloped uranium deposits in the United States.
That location is critical. Nevada is notoriously mining friendly.
Very much so. While Oregon has a, let's say, more complex relationship with resource extraction.
Right. But undeveloped is the key word there. It is a deposit, not an active mine.
Precisely. And that brings us to the timeline, which is crucial for traders to understand. Management has projected a target production date around 2032.
2032, I actually have to pause there because in the tech world, 8 years is an absolute lifetime.
Right. That's 2 generations of iPhones away.
Yeah. But in the mining world, is that standard?
It's actually fairly aggressive, but realistic. Building a mine in North America is not a quick process at all.
You get permitting.
Permitting, feasibility studies, environmental reviews, and then the actual physical construction. They did mention a possibility of pulling that date forward if conditions remain supportive.
But for now, you are buying a promise of yellow cake in the early 2030s.
That's right.
And what about customers? Do they have utilities lining up to buy this future production?
As of the listing, there are no offtake agreements in place.
None.
None yet. Management reports they are seeing early interest, which you would entirely expect given the macro environment, but nothing is signed.
Okay, so we have a large deposit, a production target 8 years out, and no signed contracts. That brings us to the cash. Mining burns money long before it makes money.
It does.
Yeah.
But this merger came with a check attached.
Right. The transaction included a $30 million public-private investment.
Yeah.
$30 million. For a software startup, that is a massive Series A. But for a uranium mine, that feels kind of light.
It is a starter pack. The expectation is that this capital will fund roughly 2 years of operations.
Which sets up a very specific dynamic for the stock.
It starts a clock.
Yeah.
If the runway is 2 years but production is 8 years away, the market knows with 100% certainty that there will be future capital needs.
Follow-on financings.
Exactly. They will need to sell more stock, issue debt, or find a partner long before the first truck rolls out of the Aurora project.
Okay, so that is the specific situation with Eagle Nuclear. But the reason this stock jumped 14% isn't just because of what is in the ground in Nevada.
No, it is because of the story surrounding it.
Right. Why does this matter to traders right now? Let's connect the broader themes here.
There are 3 themes colliding. The first is what we call America First uranium.
The push for domestic supply.
Correct. The U.S. government and utility buyers are increasingly nervous about relying on foreign supply chains.
Especially right now.
Exactly. When a new public story like Eagle Nuclear hits the wires, boasting a massive U.S. deposit, it acts as a magnet for capital looking to play that energy security thesis.
And the second theme is the one dominating every financial headline right now: data centers.
This is the real engine behind the move. Data centers are turning power availability into a bottleneck.
We are seeing a structural change where the big hyperscalers, your Amazons, Microsofts, Googles, are realizing the grid simply cannot support their growth plans with the current infrastructure.
They need more juice. And they need a specific kind of juice. They need firm 247 power.
They cannot have a data center go offline because the wind stopped blowing.
No, this is forcing them to look at nuclear not just as a nice-to-have, but as an operational necessity.
So a new uranium listing plays directly into that urgency for reliable fuel.
Exactly. And the third theme is the vehicle itself, the SPAC.
We haven't seen a ton of these lately.
SPAC listings have cooled off a lot since the 2021 boom, but this listing reopens the risk window for early-stage energy names.
It shows that if the story is hot enough like uranium is right now, investors will still embrace the SPAC structure to get exposure.
Even with the baggage that comes with it, even with the risks of dilution and volatility, it's a clear sign of risk appetite returning to the resource sector.
All right, let's get to the meat of the discussion: the winners and losers. When a headline like this breaks, money moves. We want to track where it goes for you. Let's start with the most obvious beneficiaries: uranium miners and developers.
The logic here is sympathy. A fresh Nasdaq listing validates the sector. It puts a spotlight on U.S. domestic supply.
Because data center demand is the catalyst, other companies with assets in the U.S. or friendly jurisdictions tend to catch a bid.
Right, so if you are looking at your screen, who are the peers here, aside from the new kid and UCL?
You look at the liquid established names. You have Uranium Energy Corp. You will see them under the symbol UEC.
They have a massive portfolio of U.S. assets.
Then there is Energy Fuels, trading under 4Us, symbol UUU.
They're a major player in U.S. production and processing.
And Denison Mines, symbol DNN.
They are more focused on the Athabasca Basin in Canada, but they trade in that same basket of North American supply.
When investors get excited about Eagle Nuclear, they often buy these names because they are more established and liquid.
Let's move up the food chain. Mining is just step one. You have the nuclear fuel cycle and services.
This is a crucial distinction. You can mine all the uranium you want, but you have to process it, enrich it, and turn it into fuel rods.
And then you need someone to build the reactor.
So if the thesis is that data centers will pay for nuclear, these service companies get paid too.
They do. In fact, they might get paid sooner. If we see life extensions for existing plants or new small modular reactors being built, the services companies are the ones doing the work.
Investors engage in basket buying here. They buy the whole ecosystem. Who fits in this basket?
For the fuel component, specifically enrichment, you have Centrus Energy. Watch the ticker LEU.
And for the actual hardware?
BWX Technologies is a go-to name, ticker BWXT. They make nuclear components for the Navy and commercial reactors.
And on the engineering and construction side, you have Fluor, ticker FLR.
Right. These stocks represent the industrial infrastructure required to actually use the uranium.
Now, this next group is where the rubber meets the road for the tech companies, the nuclear-linked power producers.
These are the utilities. The logic here ties back to that baseload scarcity.
If you own a nuclear power plant today, you are sitting on the most valuable real estate in the energy market.
You have the only carbon-free power source that runs 24 hours a day, 365 days a year.
And that is what the data centers are bidding for.
Exactly. So the market values that firm capacity at a premium.
Who are the titans here?
Constellation Energy is the heavyweight. They have the largest nuclear fleet in the U.S. You can find them under ticker CEG.
Then you have Vistra, ticker VST.
They have been very aggressive in positioning their nuclear assets for data center contracts.
And Talon Energy, ticker TLN.
They famously sold a data center campus right next to their nuclear plant directly to Amazon. These companies are the storefronts selling the power.
Okay, those are the winners. But markets are a zero-sum game in the short term. When capital rotates into one theme, it often rotates out of another. Let's talk about the losers.
First on the chopping block, solar and residential clean energy.
This can be counterintuitive for people. They think clean energy is winning, so solar must be winning.
But in this specific trade, that isn't how it works.
Walk us through the physics of that.
It comes down to intermittency. A data center draws a flat line of power demand. It never sleeps.
While solar produces power in a bell curve, lots at noon, zero at night.
And batteries are still prohibitively expensive for the scale we are talking about.
So when the market re-rates nuclear as the adult in the room for industrial power, capital rotates away from the intermittent sources.
Also, residential solar is a consumer product. It depends on interest rates and homeowner spending. Nuclear is an infrastructure play.
So when the nuclear trade heats up, we see pressure on names like Enphase Energy, ticker ENPH.
Correct. They make microinverters for solar. Great tech, but not a nuclear play.
And SolarEdge, ticker SEDG.
Same dynamic.
And the installer Sunrun, ticker RUN.
Isn't that their business is broken, but the hot money is leaving their sector to chase the firm power narrative?
The next group of losers might upset the traditional energy crowd, fossil power, specifically gas and coal.
This is about the incremental demand narrative. For the last decade, the assumption was renewables are great, but when push comes to shove, we'll need natural gas to back it all up.
Gas was the bridge fuel.
Right. But if the hyperscalers, who have massive ESG mandates, decide to bypass gas and go straight to nuclear, that growth story for gas takes hit.
It is a substitution effect.
Exactly. If Amazon buys nuclear power, they aren't buying gas power. It pressures the long-term demand curve for these commodities.
Which names are sensitive here?
EQT Corp is the largest natural gas producer in the U.S., ticker EQT. When the nuclear is back, headline flashes, investors worry about EQT's future market share for power generation.
And Devon Energy, ticker DVN, a major oil and gas producer.
And on the coal side, Peabody Energy, ticker BTU.
Coal is already under pressure, but if nuclear takes the baseload role, coal has even less room to maneuver.
Finally, let's look at the losers in terms of the investment vehicle itself, SPAC exposure.
This is a technical dynamic. We mentioned earlier that Eagle Nuclear listed via a SPAC.
While the stock popped, the broader SPAC ecosystem often suffers from what we call de-SPAC fatigue.
Break that down for us.
Investors have been burned by SPACs before. When a new one hits the market, it reminds everyone of the structural risks, the dilution from warrants, the lockup expirations, the volatility.
So even if Eagle Nuclear does well, it casts a shadow on the basket.
It can. It reminds people that these are speculative vehicles.
What are the tickers for these baskets?
You have the Defiance Next-Gen SPAC-derived ETF, ticker SPAK.
And SPAC and New Issue ETF, ticker SPCX.
These funds hold a basket of companies that went public this way. A headline like this can actually cause investors to scrutinize the rest of the holdings in those ETFs more closely, leading to selling pressure.
So we have covered the event, the context, and the winners and losers. For you, the trader watching this unfold, this isn't over today. What are the signposts for Eagle Nuclear specifically?
There are 4 things you need to put on your radar. The first is offtake progress.
Moving from conversations to ink on paper.
Exactly. Management said there is interest. Great. Show us a contract. Watch for announcements regarding agreements with utilities or strategic buyers. That validates the commercial viability of the Aurora project.
Second,
Project milestones. They're in the permitting phase. We need to see updates on pre-feasibility studies. Also, watch for engagement with the Department of Energy.
the DOE is handing out loans to nuclear projects right now.
If Eagle Nuclear gets a government nod, that changes the economics instantly.
Third,
Pricing. You have to watch the spot price of uranium. If the commodity price drops, it doesn't matter how good their deposit is, the stock will struggle.
but if utilities start panic buying uranium, developers like Eagle Nuclear often re-rate faster than the producers.
Meaning their stock price moves up faster, yes,
Yeah.
because they have the most leverage to the price. Their profit margin goes from theoretical to massive very quickly in a bull market.
And fourth,
Follow-on financings. Remember that 30 million figure we discussed?
the 2-year runway.
The clock is ticking. Investors will be watching closely. Will they raise equity in 6 months? Will they dilute shareholders? Or will they find a strategic partner to inject cash?
How they handle that next capital raise will determine the long-term performance of the stock. It is a high-stakes game. You have a resource that the world desperately needs, but a timeline and a bank account that need to be managed perfectly.
That is the nature of the junior mining sector. High risk, high reward.
This brings us to a clear summary of the landscape. When we look at this debut, Eagle Nuclear, ticker NUCL, it is easy to just see another ticker scrolling across the screen. But it represents a specific moment in the energy transition.
It does. This listing is a reminder that nuclear is back in the mainstream conversation. But it's not just about green energy anymore.
It is being driven by a very hard physical constraint. The grid is running out of capacity for data centers.
And the market is reacting by grouping these things together. That is the key insight for you today.
The market is increasingly treating uranium supply, fuel services, and firm power generation as one connected trade.
You cannot trade one without understanding the others. If you are bullish on AI and data centers, you have to have an opinion on where the power comes from.
Which leaves you with something pretty compelling to think about. If power demand from AI keeps accelerating at this pace, and these uranium projects don't come online until 2032, what happens in the interim? Do we eventually see the tech giants just buying the mining companies outright to secure their own supply chains? It's a completely different paradigm to watch out for.
It really is. The lines between technology and heavy industry are blurring fast.
Before we sign off, we must remind you that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Always do your own research and understand the risks before trading.
Thanks for joining us. We will see you next time.